Something unprecedented is happening in American dining. Customers are not just leaving, they are organizing, documenting, and publicly committing to never return. And the restaurants they are targeting are not taking it quietly. They are spending millions fighting back with lobbying, rebranding, and legal pressure designed to make you forget why you left in the first place. These are the major chains at the center of America's biggest dining boycott. And the pushback from each one is more calculated than you think. Take a look at the data from the past 24 months. We are witnessing a fundamental rupture in the unwritten contract between the American consumer and the multi-billion-dollar corporations that feed them. For decades, fast food and casual dining operated on a simple premise: predictable quality, speed, and affordability in exchange for blind consumer loyalty. That contract is dead. Driven by an unprecedented convergence of explosive pricing, algorithmic corporate decisions, and geopolitical flashpoints, millions of citizens have done something executives thought impossible. They broke the habit loop. The financial fallout is no longer a corporate secret hidden in internal memos. It is laid bare in quarterly earnings reports and string of sudden, unannounced restaurant closures across the country. When a franchise location that has stood for 30 years in a Midwestern suburb abruptly locks its doors and posts a typed letter on the window saying it is closed for good, that is not an isolated business failure. It is a casualty of a quiet economic war. What makes this shift catastrophic for the industry is that these boycotts are not decentralized, passing social media trends. They have become highly organized, institutionalized movements. Consumers are utilizing real-time data tracking, supply chain mapping, and coordinated financial strikes to target specific corporate vulnerabilities. When a customer films a $15 receipt for a basic value meal and that video accumulates 10 million views, it ceases to be a complaint. It becomes a viral mandate for mass departure. The corporate counteroffensive is massive, invisible to the untrained eye, and profoundly expensive. We are talking about the deployment of high-stakes crisis PR firms, the artificial manipulation of value narratives, and strategic executive shifts designed specifically for brand rehabilitation. Corporations are pouring millions into loyalty apps, not to give you discounts, but to harvest behavioral data that can help them predict how to pacify your anger before it hits their bottom line. They are fighting for the survival of a business model that relies on your passive, unthinking consumption. But the real mystery isn't that people are angry. The real mystery lies in the structural trap these corporations have built for themselves. In their frantic effort to maximize short-term shareholder value through aggressive price increases and global expansion, they have alienated the exact demographic groups that sustained their growth for half a century. They have traded decades of built-in consumer trust for a few quarters of inflated profit margins, and now the bills are coming due. The question hanging over the entire food industry right now is simple, yet terrifying for Wall Street. Can a corporate giant actually buy back a consumer's broken habit? Once a family realizes they can eat better, cheaper, and more ethically by completely bypassing the drive-through lane, the entire psychological spell of convenience is broken. The tactics being used right now by the largest food conglomerates in the world to force you back into that lane are darker, more systematic, and far more deliberate than a simple marketing campaign. To understand the sheer scale of this crisis, we have to look past the corporate press releases and analyze the precise mechanisms of how these multi-billion-dollar empires began to fracture from the inside out. The current crisis did not emerge from a vacuum. It is the direct consequence of a massive structural geographic trap and a series of fatal financial miscalculations that began over a decade ago. To understand how the American dining industry reached this breaking point, we have to look back at the corporate real estate boom that followed the 2008 financial crisis. During that period, historically low interest rates allowed major restaurant conglomerates to embark on an aggressive debt-fueled expansion strategy. The goal was simple: saturate every suburban commercial corridor and highway interchange in North America to secure market share and project artificial growth to Wall Street. By 2019, this expansion had created a profound geographic vulnerability. The United States became severely over-retailed, possessing more than double the restaurant locations per capita compared to any other developed nation. Corporate headquarters managed these vast networks through highly centralized, rigid corporate frameworks. This system worked as long as two variables remained completely stable: cheap commodity supply chains and a massive pool of low-wage labor. Then came the inflationary shockwaves of 2021 through 2024. Global food commodity indices surged by 28% in a matter of 36 months. The primary input trio for the fast food industry, poultry, beef, and cooking oil, experienced unprecedented price volatility. Simultaneously, the domestic labor market tightened dramatically, forcing franchise operators to raise baseline wages to maintain minimal staffing levels. In response to these soaring operational costs, corporate executives made a critical, unanimous decision. They chose to protect their short-term operating margins by passing 100% of the financial burden directly onto the consumer. This is where the geographic trap closed. Because these corporations had spent years building thousands of identical low-margin locations in identical suburban strip malls, they could not easily scale back operations without triggering a catastrophic drop in total revenue. They were locked into expensive, long-term commercial leases and massive overhead costs. To pay for this overextended footprint, they had to extract more money from fewer visitors. Corporate financial teams turned to algorithmic menu engineering and automated dynamic pricing models to squeeze maximum profit out of every transaction. Between 2022 and 2025, the average price of a fast food meal in major metropolitan areas outpaced core inflation by more than double. A standard combo meal that cost $7 in 2019 climbed past $14 by late 2024. This pricing strategy was based on a flawed assumption. Executives believed that fast food was an inelastic good, meaning that because people need to eat and value convenience, they would continue to pay whatever price was displayed on the digital menu boards. They completely misjudged the breaking point of the American working class. For families earning the median household income, the drive-thru transformed from an affordable, daily convenience into a conscious, calculated luxury. As transaction volumes began to plummet in mid-2024, corporate boards panicked. Rather than lowering prices across the board, which would have damaged their stock valuations, they attempted to mask the underlying structural rot with temporary, highly publicized value promotions. They introduced short-term $5 meals and temporary app discounts designed to lure customers back into the habit loop. But the data shows these promotions failed to shift the long-term trend. According to institutional financial tracking, while traffic spiked slightly during the first weeks of these promotional campaigns, overall consumer spending continued to shift away from traditional quick-service chains. Consumers used the discounts, refused to buy higher-margin items, and left. The industry had entered a dangerous phase where the traditional economics of fast food no longer functioned. The massive infrastructure built for high-volume, low-margin throughput was now running at a fraction of its capacity, while input costs remained stubbornly high. In 2024 alone, 20 major restaurant chains filed for bankruptcy protection, marking the highest level of corporate insolvency in the sector since the absolute peak of the 2020 pandemic lockdowns. Deloitte Show 1. The geographic expansion that was supposed to guarantee eternal corporate dominance had become an anchor dragging the empires down. The physical locations themselves became liabilities, standing as empty, expensive monuments to an era of cheap money and passive consumer compliance that is never coming back. The financial standoff between consumers and corporate dining empires has entered a critical, adversarial phase. What began as individual complaints about $14 combo meals has solidified into systemic, organized consumer resistance that is actively re-engineering the food service sector. We are no longer discussing hypothetical consumer dissatisfaction. The hard operational data from 2025 and early 2026 indicates a structural realignment where major corporations are locked in direct conflict with their own customer bases. The friction is most visible in the aggressive tactics deployed by corporate headquarters to contain the damage. In mid-2025, consumer advocacy coalitions initiated highly targeted economic blockouts against several fast food conglomerates. These were not simple internet trends, they were structured. data-driven campaigns focusing on specific corporate vulnerabilities, including executive compensation ratios, corporate tax strategies, and abrupt rollbacks of corporate social responsibility commitments. The immediate impact was mathematically devastating for major brands. Corporate financial statements filed in the latter half of 2025 revealed that domestic comparable sales for some of the world's most ubiquitous quick-service brands plummeted by 3.6% in a single quarter, driven by a 2.6% drop in absolute foot traffic. To counter this organized flight, corporations have weaponized algorithmic surveillance and loyalty program infrastructure. Behind the benign facade of mobile application discounts lies a highly calculated strategy to bypass public accountability. By offering hyper-targeted, localized digital coupons, corporate automated systems work to fracture the collective bargaining power of boycotting consumer groups. If the corporate algorithm detects that a specific zip code exhibits high levels of boycott participation, it systematically floods local app users with aggressive, low-margin offers to artificially stimulate traffic and disrupt the boycott's momentum. This creates a hidden, ongoing technological battleground between consumer data privacy and corporate behavioral manipulation. Simultaneously, a fierce internal conflict has erupted between corporate franchisors and local franchise owners. The traditional franchise model dictates that while corporate headquarters takes a fixed percentage of gross revenue, the individual store operator bears the entire burden of localized operational costs, lease payments, and labor expenses. As corporate entities demand the implementation of national value menus, such as the highly publicized $5 promotional bundles, to protect the global brand's market share, individual store owners are pushing back aggressively. Franchises are openly documenting that these corporate-mandated discounts force them to operate at a net loss, escalating tensions to the point of litigation. In late 2025, groups of independent franchise owners filed joint lawsuits against parent corporations, alleging that centralized pricing mandates constitute predatory business practices designed to bankrupt independent operators while insulating corporate shareholders. The Guardian: The physical landscape of American retail reflects this structural breakdown. The sector has entered an era of sudden, unannounced mass liquidations. Major national brands are quietly executing dark closures, abruptly shuttering underperforming locations overnight without prior notification to employees or local communities to prevent labor unrest or negative regional press. Institutional bankruptcy filings have surged to historic levels. Landmark restaurant groups that defined the casual dining landscape for decades have collapsed under the weight of predatory leveraged buyouts and securitized debt instruments that assumed consumer compliance would last forever. When a major holding company files for Chapter 11 protection, it triggers a dove effect across the commercial real estate sector, leaving thousands of suburban strip malls anchored by empty, decaying commercial kitchens. Restaurant Business Magazine: This is the current institutional dead end. The corporations cannot lower baseline menu prices without triggering a massive sell-off of their stock by Wall Street institutional investors who demand ever-increasing profit margins. Conversely, the American consumer, squeezed by broader macroeconomic pressures, flatly refuses to return to a pricing model that feels explicitly exploitative. The industry is stuck in a highly volatile equilibrium where public relations spin, aggressive corporate lobbying, and desperate technological interventions are failing to repair a fundamental collapse of institutions.